As we develop money fit for today and technology that will underpin it, we sit with David Birch to learn more about how this will look and feel like. David, so happy to have you here today with us.
My
And
pleasure, Morel. Thank you for inviting me.
yeah, and without further ado, I'll dive straight into the topic. Please, can you give us some examples of digital money we will be using in the future? Is it crypto, stablecoins, CDBCs, or NFTs, DeFi, all, none?
Well, potentially it could be all of those. What I would probably do is start by thinking about, I have to think of these things in a very organized fashion. So I start by beginning to think about the difference between money and cash. So if we think electronic money is money that lives in bank accounts, essentially, and electronic cash is money that lives outside bank accounts. So if we think about that very simple, so right now I have some pounds in my bank account and I have some pounds in my house. I'm sure, I don't know where. I'm sure I do, but I haven't seen any recently. But you get the general point. So there's money and cash, and what we're talking about here is really cash. We're talking about value that's going to be exchanged person to person without necessarily going through the third party systems. And of course, this is the area of innovation. For the electronic cash, we can think of that as in three different parts. So there's sort of value which is nothing to do with anything else. It's value which is just created by mathematics and consensus and the ledger, like Bitcoin and so on, where the value is intrinsic to the system. Then there's value which depends on something outside the ledger. It's tied to something else. And we can divide, I would loosely call those digital assets actually, rather than cash, because one of the interesting things about digital assets, of course, is that they're money-like in the sense they're exchanged person to person, not through, market makers and clearing and settlement and all that sort of thing. So those digital assets, we can, at a very high level, we can back them in two ways. We can back them by property or we can back them by money. So we have digital assets that are backed by property. It could be gold or it could be intellectual property, as some of these things are laughably labelled, pictures of chimpanzees and things. So we have assets that are backed by property, and then we have assets that are backed by money. And in the old days, we used to call those currency boards because it was one type of money that had a reserve in another type of money. But the word stablecoin has sort of taken over for all of these. That's not what stablecoin originally meant. But stablecoin has come to mean all of these forms of money that's intrinsic to a ledger but is algorithmically controlled to try to maintain a stable exchange rate. Money that has a value extrinsic to the ledger which is rooted in property, and money that has value extrinsic to the ledger rooted in other kinds of money. Those have all become called stablecoins. I object to that, but it doesn't matter. It's like me complaining about smart contracts. Nobody pays any attention to what I say about this. Now, if we look at that third category, money that's backed by other money, you could have two possibilities there. It could be issued by private companies or it could be issued by central banks. Now, in the case of money that's issued by commercial companies, we already have lots of experience in that. You go to Africa and you see M-Pesa that has 50 million users, Africa's biggest fintech, and every day people are taking commercial bank money, for example, Kenyan shillings, and they're taking them to agents and they're exchanging those for a claim on private bank reserves. So the M-Pesa reserves are held in commercial banks, private banks. So you take your public Kenyan shillings and you exchange them for private M-Pesa shillings, and the whole system works and everybody's happy. As long, of course, as that claim on the Kenyan shillings by the banks will be honoured, which it is. But nonetheless, some people think there's always a slight risk, even if the risk is very small. There's always a slight risk that claims on private banks might not be honoured for some reason. The banks might go bankrupt, or Again, I mean, I stress, in a properly regulated environment, I don't think that's particularly a problem. And actually, we have evidence of that in the UK, of course, because of the collapse of Wirecard. So when Wirecard was an electronic money institution in the UK, as a result, it was required to keep the claims in the form of Tier 1 capital, in particular bank reserves. And of course, those bank reserves are covered by not federal, but, government deposit insurance. So when Wirecard went bankrupt, the stockholders and the bondholders take the hit, but the customer's money was in 100% reserve in bank reserves, commercial bank reserves, and the customer money was safe. So personally, I think with proper regulation, whether we have, I mean, you see this discussion in the US at the moment. Should there be a Federal Reserve US dollar, or should we use the Circle US dollar? Or should we wait for a Google US dollar or a Facebook US dollar, a DM US dollar, whatever they call it? Now, obviously there are some issues in making sure those things are properly regulated. And if the private reserves get very big, I mean, I don't want to make any sort of comment on the situation, but if you look at the case of Tether, which is, the dominant stable coin at the moment, I know a lot of people sort of they're joking, but only partly joking when they call Bitcoin a Tether derivative, since there's 100 billion a day in Tether being traded all over the place. Well, I think Tether is now there's a 69 billion in reserves. So when you start getting into the sort of 69 billion, then obviously that has some systemic issues associated with it. But conceptually, with proper regulation, would it matter if the stablecoin was issued by the commercial bank or by the central bank? But, there are good reasons for saying, well, okay, cash is going to be just as important as money. As electronic cash is going to be just as important as electronic money. We want electronic cash to be a sound platform for the future for a variety of reasons. One of which, of course, is innovation. If there was an electronic pound, and that electronic pound had good APIs and good service levels and all this sort of thing, it's reasonable to assume that clever people would build interesting new products and services that sit on top of that, and also use it to solve some problems that the conventional infrastructure finds difficult, like micropayments and things like that. So there's an argument for saying, well, okay, instead of having private companies trying to compete, and because they can't earn very much money on the reserves, if the reserves are properly regulated, that means their margins will be driven down, and you get what economists call the big problem of small change, which is very hard to make money out of very small amounts of money. So it would sort of make sense to not do that and just have the central bank issue the digital pound or digital euro or digital dollar, and let private companies build things on top of that. For those kind of initiatives, by which I mean the stablecoin issued by the central bank, or CBDC as people call it, central bank digital currency. For central bank digital currency, I tend to think of that as being in six. And you see, I'm a horrible nerd. I have to partition everything up, otherwise I can't think about it. For central bank digital currency, I think of it in three groups of issues. There's the sort of politics and economics. That's one thing. There's kind of the social issues. That's the second thing. And then there's kind of the technology stuff. That's the third thing. So if you think about the first thing first, the political and economic, you have the impact of the CBDC on the domestic economy and the domestic money supply. That's one issue. But of course, you also have to think about the impact of the stable coin externally. And for some countries, that's quite a concern, because as you can imagine, if there was a digital dollar, let's say the Facebook DM digital dollar, and let's suppose anybody anywhere in the world can store that digital dollar on their mobile phone.
On their Novi wallet.
On their Novi wallet, exactly. Well, there are a lot of countries where people would never use the local currency. They would only use that. And that has implications for the policies of those countries. How can they control their own economies if nobody's using their currency? So there are these political and economic issues which I am not qualified. You need to talk to an economist about those kind of things, but I recognise the issues are there. Then you've got the social issues, and the social issues relate in two things really. So first of all, there's the issue of cashlessness, and the fact that a central bank digital currency, in my opinion, has to be introduced at the retail level in the context of a more general strategy towards cashlessness. If you just allow things to go cashless without a plan, without strategy, I don't know that you get optimal outcomes. You get some groups of people who are marginalised and excluded, and I don't think we want that. So I personally think, certainly in Europe, we should have an overall strategy towards cashlessness, and CBDC should fit within that strategy. It has a social context, And the other thing, when I wrote a book about this last year, and one thing I didn't think about when I was writing the book, but has become important over the last few months, is another social issue, which is sustainability. And here in the UK, we've got I can't think what the name is. It's the UK Cash sustainability group or something. So the people that do the armoured cars and ATMs and that, they're trying to become more sustainable, use less single-use plastic and all this sort of thing. So it'd be crazy to replace cash with something that's less sustainable, where every time somebody sends somebody else a picture of a chimpanzee, you have to burn down an acre of the rainforest to make the transaction happen. So I didn't really think about sustainability when I was writing the book, but it's clear to me now with some of the work I'm doing around the world that sustainability has become a much bigger part of that. And then, of course, there's the sort of technological issues, and I divide those into two parts. There's the technology of the CBDC itself, and we have to think carefully about how that adds to, because this is crucial national infrastructure. It doesn't matter if Facebook goes down for an afternoon. Well, it doesn't matter to me. But there are big parts of the world where Facebook and WhatsApp are the internet, and so when WhatsApp goes down, it's a systemic failure in the economy. Well, we don't want that for cash. Cash can't go down. So we have to build a resilient infrastructure. And what that largely means is it has to be an infrastructure that can work offline. So much as in China, they've decided to allow offline person-to-person transactions in the presence of secure tamper-resistant hardware, I think we should think about doing the same thing in Europe, and certainly in the UK. And then finally, the last issue, so now the last group is technology, and the last technology issue is the thing I touched on earlier on, which to me is the most important part, which is innovation. Which is, if we're going to do this, in my opinion, there's no burning platform, right? So there's no pressing need in Europe for some sort of retail digital currency. We all use our debit cards and they work pretty much fine, pretty much most of the time. Obviously, I can think of examples where they don't and where electronic currency would work. But that's not the point. The point is, for most people, most of the time it works. There's no pressing need for doing that. So it's the innovation on top of it that will deliver the new products and services to people. So I would say there's no great urgency on retail digital currency. But when we do bring it in, it has to be a technology platform that allows for real invention on top of it, real sustainable innovation, things that really reduce the friction, lower the cost of financial services, increase trust and reliability, like things that do things in a really new way. And of course, this is where it begins to touch on the world of DeFi and decentralized finance. Because if the platform is going to allow the interchange of digital assets and digital money in these automated environments, essentially, I mean, this is basically bots trading with other bots, which is not in itself a bad thing. In fact, it could be quite a good thing, because one of my thoughts about this is it might actually be easier to regulate bots than people, because you can tell people what to do and they still don't do it. They'll still go down the pub and start insider trading, even if you told them not to.
Yeah, but on the other hand, you have this. How do you insert bot thinking within bot? I mean, we would insert human thinking within bot.
But you could have the regulations built into the bots. So you could say, you could imagine a system where traders are allowed to, people talk about money Lego, plugging together money Lego. But suppose you could only get that money Lego from places where it had been certified and inspected and regulated. I think there's some really interesting new thinking to be done there. So my point is, to me, that last part about innovation is the most important part. I don't see any need to do it tomorrow. So I would rather we spent the time thinking through the platform and coming up with a platform that can provide, a real improvement in the world of financial services. Anyway, so that's sort of my summary. So you've got money and you've got cash. In cash, you've got property and money. In money, you've got commercial banks and central banks. And for central banks, we want something that's really going to change things, not just a different way of paying for things in the shops.
And if we were to think about the DeFi space, how we would insert this topic within the central banks? So how, also cross-border trade would look like without intermediation? Would be like bots talking with bots in a way?
No, it sounds funny to say that, but actually I think you're right. I think that's what it is. I mean, I think the world of DeFi right now is largely bots trading with other bots. They're just doing it in a very unregulated environment. And when somebody disappears with millions of dollars of other people's money, it's just, whatever. But that can't be sustained into the mass market. But I think a recognition that the future financial markets are bots trading with other bots, I think that's useful and important. Apart from anything else, it means that the financial instruments that they can trade can be much more complex than the financial instruments that people trade. And people already don't understand half the instruments they trade. I mean, look at what happened in the crash. But if the purpose of the financial market is to reduce the cost of doing business, to cut down risks, that kind of thing, there could be much more complex financial instruments that are constructed to meet the needs of particular industries or particular sectors. And bots could trade those happily. To me, that's not a negative thing. I think a recognition that the future of finance is bots with other bots should influence our thinking about how we construct central bank digital currency.
Yeah, and regarding banks, how would we interact with money if banks didn't exist? I mean, we can think also about central banks or commercial banks. And what role should banks play in the financial services industries of the future?
Well, I mean, again, when you say bank, to me, that means something very specific. A bank is something that creates credit. The historic overlap between banks and payments is essentially an accident. There's no particular reason why it's banks that should provide payment services on such a large scale, and I'm pretty sure in the future they won't. So what is the role of banks? The role of banks is to provide credit. And that's why, and that's the time bomb that can blow things up. So that's why they have to be very, very heavily regulated. Payments can be regulated in a different way, and they can be provided by other people. And I know you get bored of me saying this, but the key to reducing costs on that side is actually identity. I mean, the frauds and the problems. If you fix the identity problem, then you fix the payments problem. So I don't want to tell you about this again. I told you this. You're already yawning, I can see from hearing this again.
No. But the fact is, actually, we've written a lot about the GAIN initiative, the Global Assured Identity Network, that promotes this idea that banks are the perfect fit for data custodians and digital identity custodians, and to provide verifiable credentials to users. So it's not yawning. It's
I agree. I
the
agree
opposite.
With that. I mean, the reason I put my name to the GAIN initiative was that I just refuse to give up, no matter how little the banks do in this area. I'm convinced this is the right place to start. Banks have already done the KYC. They already have the information. What they need to do is find a framework in which they can exchange that. And I think GAIN takes us in the right direction. You can argue to me that it's not perfect, that it's not the end point, perfectly reasonable. But the situation that we have now, where fraud is completely out of control, is just utterly not acceptable. We've got to do something. And I really do think it should be the banks, not the government, that does it.
So in a bank won't necessarily disappear, but yeah, they are advised to shift to shift roles.
Well, look, I mean, in a way, I know it's but in a way, it's sort of already true. I mean, I don't have very much money. Obviously, I'm just a consultant. But what little money I do have isn't in the bank. You know, the bank holds my overdraft, and I use it for doing some credit card payments and things like that. But it doesn't have my money there. My money is in, you know, pension funds and you know, stocks and other things. It's not really, but you get the general point. The bank already doesn't really have my money in it. What the bank has is my identity, my reputation. It's just they don't think of it in that way, and they don't monetize it. In that world of DeFi, the kind of reputational calculus that will be attached to transactions. Do I want to trade with this person? What kind of risks am I prepared to take with that? That really is an interesting new way of organizing markets, and I would think banks could play a key role in that. In theory, at least, even if the bank isn't going to tell you who I am, the bank does know who I am, and that's important.
Yeah, and you mentioned this fact that you don't have money in the banks, so in a way you kind of need a bit of protection, even if, let's say, they go to DeFi space. And now protection is also connected with regulators and to shift the ball in their court. What are they doing or not doing, what should be doing about this emerging alternative banking sector?
I'm not an expert on regulation and what the regulation should be, but I would imagine that people who are experts are taking DeFi pretty seriously, because, you know, even if you don't think the kind of underlying cryptocurrencies are stable or in the long run the right way to do things, I think the pressure for these kind of more efficient decentralized markets is real, and it doesn't come from technologists. It comes from the money men. So yeah, that's a bit different. Anyway, we'll see. You can interview me in a year and we'll see what's happened.
Yeah, and now we'll do like an imagination exercise. I remember in one of your books, Before Babylon and something with Bitcoin, I don't remember the exact title, you did a similar exercise at the end where you would enter a shop and everything would be seamless. Now my exercise would be imagining that DM has been rolled out, and would be interesting to see how is the financial world looking like post the DM launch. What can we learn from it? What do you think? Also taking into account this outage that happened for 6 hours, and yeah, kind of.
Well, but that just tells us that my point about digital currency is right. You know, for retail digital currency, for the mass market, it has to be able to work offline. It cannot be an online solution.
So let's try, quickly, the imagination exercise.
Well, but I would challenge you with that, because I say, you know, if I'm right that environment is an environment of bots trading with other bots, I think it'd actually be quite hard to imagine how that will evolve, right? Because they will evolve their own financial instruments to do their own risk management and to make their own transactions more efficient. And, you know, the idea that we'll be able to guess what that is, I'm not sure about that, actually. I mean, we're not that far away from artificial intelligence being smarter than, I was going to say smarter than me, but that's not a very high bar, is it? I think the researchers are aiming for more than that. It's a genuine answer, Maria. I think it's quite hard to imagine that, because I think you're looking at an environment of much more complex instruments being traded millions of times more frequently than instruments are traded today, in order to try and reduce the overall cost of financial intermediation. And that is quite hard to imagine.
So we'll leave this as an opportunity for another interview.
Absolutely, absolutely.
Yeah, the imagination game. Thank you so much, David, for making time to
Not at
speaking
all.
with us.
Thank you, Maria. It's lovely talking to you as always. See you
Yeah.
again soon.